Well, good evening, everyone. I hear some music. Thank you very much. It is a real pleasure and an honor to be back. Dan, thank you very much for inviting me. Congratulations to Dan. He's going to be in charge of your programming next year. So he has assured me he's going to find a really good economist to come next year to tell you what's actually happening. I think this is my lucky 7th year. You have such an active chapter. It's always great to hear the resumes of the students who just won your awards. If I'd have been anything like that at their age, my career might have amounted to something. But congratulations to them on their well-deserved scholarship and no doubt great careers ahead of them. And I was listening to their questions very, very intently, and I will get around to answering a number of them. And then, of course, when I'm done with my prepared remarks, hope as always with this group to get good questions from you. And we can get at things maybe I didn't address in my prepared remarks. Now, I think I told you a couple of years ago, I was PNC's chief economist. I've been with PNC for 39 years. That is something that doesn't happen too often anymore. It's been a wonderful experience for me. Great colleagues like Dan, Kelly, others in the room. Hopefully you know how embedded PNC is in the Chicago community and how long we've been here and have good experience working with them. And I'm proud to represent them tonight. And I know they're really some of the best people in the business. So as I say, 39 years, a couple of years ago, I passed along, shall we say, the baton of chief economist to my successor, the guy I had groomed. He's doing a great job. PNC asked me to stay. And said I could do the things I like to do, which is talk to clients and groups like yours, as I've done many years in a row and many others throughout the ever-growing PNC market, almost encompassing most of the country now. And I still get involved, which will be relevant to a couple of those great questions from the students dealing with the stock market and some of our investment strategy. So it was a good deal. I'm still a full-time employee of PNC. And I'm working 24/7. That's 24 hours a week, 7 months a year. And it is the best job. So it's worked out very, very well for me. We'll see if we do it for a little while longer. Thank you, by the way, for moving your date up one day earlier. Originally, Dan and I had talked about doing it tomorrow. I know normally you have your meetings on Thursday, but I could foresee even back then what a beautiful weather would be today and how easy it would be for me to fly from Pittsburgh to Chicago after one canceled flight. And tomorrow is going to be just terrible, sunny and a little milder. So maybe I will be able to move out to Cincinnati where I'm headed next. So what I want to do for you today, and we've done a PowerPoint. I don't know if I've done that many of them in the past. And since I might, I'm going to move out a little bit so you can see me from behind there. Look at the title. How many students ask, are we headed into recession? I think that kind of goes with my title, Recession Obsession. But I think the answer is, to them and to all of you, fears a couple of months ago, rampant in the markets in late last year, as it was just cratering, fears of a recession are greatly overblown. And I'm going to explain to you why we think economic growth is going to slow down, indeed already has, and that there are a number of challenges facing all of us across the country and across the globe, but we still think that recession is not in sight and is not likely to happen, at least for the next couple of years that one could reasonably foresee. So when many of you graduate, I think it was 2020, I'm sure that you will all find good jobs, which you would anyways, given your credentials, but hopefully it'll be good for all of the many students graduating college and high school and grad school in an economy that is still doing very well and in a job market that is extremely hot. In fact, if I ask this room, and it's been many surveys, how difficult is it? I'll ask you by show of hands. How is it difficult for you to find good, qualified employees to hire in your business or to retain them? Pretty large number of hands. That's certainly true at PNC. That's why they kept me around. If they could have found a good economist in this tight job market, they would have hired somebody, but instead they're still stuck with me. But you're not alone. The vast majority of small and large businesses say that finding good, qualified employees is hard and retaining them, and that's why wages are picking up, and hopefully some money will be invested in training and apprenticeships as well for the young people earlier this evening and many of their classmates as they go out into the working world. So, no recession in our outlook for the next couple of years. What this is the economic expansions going back to 1933 when I first started at PNC. This is the length in months. 115 and counting. We've been growing almost 10 years. This June, if we get there, and I believe we will celebrate the 10th year anniversary of this economic expansion. We will tie the decade of the 1990s, which is the longest expansion in modern time, and we're going to get there, and by our forecast, go beyond it. And I'll talk to you about why we think that, and certainly what are the risks to that not occurring or to us not staying, the U.S. country, the U.S. economy, staying in growth. And here's a bunch of reasons. First, as I mentioned, we've had a very long economic expansion, but it hasn't been that strong. Growth has been GDP. That's the broadest measure of economic activity. It's $20 trillion for the U.S. economy. China's about $13 trillion. Japan's about 12. The whole European Union, if you added it up, is about a little bigger than we are. So that measure of economic growth, and of course it doesn't address issues of income inequality and a number of other things, but as a broad brush measure, gross domestic product, GDP, is what I showed you there, the number of months we've been in expansion based on that measure. It's been long, but it hasn't been that strong. Last year, we grew about 3%. We'll get the final numbers next week when the government, now they're back in business, they'll give us numbers, so we're missing the fourth quarter. But fourth quarter growth last quarter was probably around 2 to 2.5%, slower than the third quarter, slower than the second quarter, so we are decelerating. But for all of last year, about 3%. That's actually one of the fastest years for economic growth, as I'll show you in a few minutes, we've had in a while. But if you took all those years of economic expansion and cumulatively added them up for GDP, that 115 months and hopefully counting, and you said, well, let's just go back, we won't go back to the 30s, but let's go back to the end of World War II. So we've had about 11 expansions. You might think, well, since this is going to be one of the longest, it must have been one of the strongest. It's not. If I showed you total economic growth, GDP, before the next recession hit, for all of those previous expansions, and said, where are we today in that list? We're right about in the middle. So we've had 4 and 5 year expansions in the past. As you can see, 58 months, 92 months, a little longer, 24 months, that have actually had more growth over those shorter period of time. So what we're lacking, or what we're having length, we've lacked somewhat in strength. But there's a good side to that. This is the tortoise and the hare. We've had a slow but persistent economic recovery. And the good thing is we haven't built up, and this is one of the reasons I don't think we're going to see a recession, we haven't built up the excesses that past economic expansions build up in even shorter periods of time. Excesses such as inflation, Fed raising interest rates, excess of inventory, financial debt like 10 years ago in the housing market, the amount of subprime debt. There are some issues in autos, but nothing compared to last year. So at least in the private sector, because we certainly piled on a lot of federal debt. So the kind of, like you say, vulnerabilities or excesses that economists look for are pretty much absent. And that's one of the reasons why I think economic growth still has a ways to go. Next reason, anytime you're going to try to forecast the economy, you better think about the American consumer. All of us in this room and the other 300 plus million of us out there, earning money, spending money, saving money. The American consumer what we spend accounts for 70% of that $20 trillion GDP. Now, exports are important. Business investment is important. Housing is important. Non-residential construction. Government spending. But you add them all together, that's the other 30%. So that's not to say you can't have a recession led by businesses or exports, which is what one of the big downside risks is. But if the consumer is doing pretty well, it's less likely you're going to have any kind of an economic downturn. And the consumer is doing quite well. Jobs have been very strong. I'll show you a few pictures on that in a few minutes. Incomes are growing. Wages are going up at a faster pace. Finally, just over 3%. Took a long time and will probably stay there or go even higher as that issue of keeping qualified employees or retaining or attracting them forces business, and rightly so, to pay up for their better, hopefully more productive workers. Now, consumer confidence took a hit the last couple of months. During the period of, November, December, January, the government shut down, the big drop in stocks. As I'll show you in a minute, consumer confidence straight down. And business confidence also went down, although from very high levels to not so, not that high, but still pretty good in a historical context. So the jobs, the income, gas prices fell 22% over the last 3 months. That was around 60, 70 cents a gallon. This winter, we have some of the lowest gasoline prices we've had, not natural gas, gasoline prices we've had in years. And while that's probably hit bottom, as it typically does, it's also put a lot of money in consumers' pockets. So I think the American consumer is in pretty good health. And while they're not going on a spending spree, they're not going to go out over their skis, they are likely to continue to spend at a 2.5% rate. And with that being 70% of GDP, it's pretty hard to have a recession. If 70% of the economy is growing moderately, it would take some awful declines in the rest of the economy to drag us all down. But at the same time, as I say, financial conditions of companies, especially after the corporate tax cuts, individuals, and we're in tax season finally, now that I guess the IRS is back at work. The one bad side of the government shutdown ending was the IRS went back to work. But maybe if you're getting a refund, you're glad they're back in work. But the financial condition of banks, consumers, businesses is very good. Looks nothing like 10 years ago when the financial markets and the credit melted down. Another reason, the Fed. And I'll come back to talk a little more in detail. One of the excesses I mentioned that has caused the end of recessions in the past has as often as not been the Fed was chasing inflation that was getting out of control, going up too fast. And the Fed chased it by pushing interest rates up. Inflation today is not a problem. It's actually below the Fed's target. I'm going to show you a lot of pictures to go along with this, but I'm trying to give you, paint the picture right now in words, and then I'll show you some charts. The Fed just recently said, look, we raised rates a lot. We're going to, I call it be patient. Just today, the minutes of the Federal Reserve's meeting at the end of January came out and reiterated what we already knew. After raising rates in 16 a little, 2017, and 4 different times, 0.25% each. In 2018, including December, the Fed has said, let's be patient. Let's wait and see. And that's the right thing to do. There are lags between what the Fed did last year and their effects on the economy. They talked about global concerns, Brexit, and China slowing down, and certainly the trade talks going on between us and China, and now maybe some talk about auto tariffs or tariffs on autos imported from Europe. So I think the Fed was right to say, whoa, let's put on the brakes for now. And then actually one of the leaders of that, well out ahead, was the Chicago Fed president, Charlie Evans, a good friend of mine. And he pretty much argued against a couple of the rate hikes last year. And now the committee, since it was a unanimous vote, agreed, let's wait and see. We don't think the Fed's raising rates for at least the next probably 9 months, 6 to 9 months. And it's a little more technical. They're shrinking their balance sheet, but they're probably even going to taper that off a little bit. And that was something they talked about today. Fiscal stimulus. There was a big, as we know, tax cut last year. And that helped reduce income taxes for individuals and businesses. There was also about a year ago, at that point, Republican-controlled Congress passed a huge spending bill, $300 billion, all deficit financed. But that put a lot of money into the non-defense and to the defense industries. And that's still around, but it is dissipating. So the big push it gave to economic growth last year, which I think was in part why growth was 3%, is dissipating. It's not going away and it hasn't reversed, but it's less stimulative as you go forward. Another reason to slow down. The bottom one is what I worry about most. Our relation, and that was one of the questions, good question, our relations with the rest of the world, and particularly with China. Now, there have been talks going back and forth between D.C. and Beijing. I believe they're in D.C. now. The president suggested the other day that this March 1st deadline, which is what, a week and a half away, to impose or to raise the 10% tariffs that have been in place since, I guess, middle of last year to 25. He said, well, there's nothing magical, nor should there be, about March 1st. So it may well be that the negotiations don't reach a conclusion, but we don't raise 10% tariffs to 25, in which case the Chinese would retaliate. And by the way, they own a lot of our treasury bonds, over $1 trillion. And selling them would definitely be cutting off their nose to spite their face. But if all's fair in love and war, I guess that includes trade wars as well. So we don't want to go there. So I'm hopeful. We got the government back open, and it stayed open with a deal. We got the deal last week. We know, I guess the Mexicans are not going to pay for the wall. But the good news there is I recently learned that El Chapo has agreed to pay for the tunnel under the wall. So we're okay there, so the Mexicans are going to put up some money. That was my wife's joke. She told me I could use it. So the question, what happens with us in China is very important. Europe is quite weak. Italy's in recession. Although when you drink that much wine, you never notice it. So the Italians are in recession, but it feels the same to them as it always does. The Germans were skirting with recession, but just barely avoided it. The UK, of course, trying to deal with Brexit. Are we going to have the so-called hard Brexit? That's another deadline, March 31st. We'll have to see. It would not do the world economy any good, let alone the continent and Britain, to have that messy of a divorce. The War of the Roses. You saw the movie. Some of you are too young to remember that. I think there was also a 100-year War of the Roses a couple of centuries ago in Europe. I don't think that we're going to have a hard Brexit. And in fact, that deadline might slip a little bit to give the Europeans, the continental Europeans and Britain a little time to try to work things out. But my gravest concerns for the U.S. economy are the weakness abroad in our trade relations, economic, maybe diplomatic trade relations that we have with the rest of the world. So what I've tried to lay out for you here is a picture of slower economic growth, a little more cautious consumer, no or very little fiscal stimulus, concerns about our exports to the rest of the world, both because of potential tariff accelerations and just the fact that Europe and China are growing more slowly. I mean, China puts out these official numbers. They grew 6.4% last year. I don't know why they need to wait. They could just announce now what they're going to grow this year. 6.2%. And whatever they say they were going to grow, that's what they're going to grow. The people that I keep in touch with suggest China's growth is a lot weaker than that, maybe half that. So that gives the Chinese an incentive, as well as our own incentive, to come to a deal. Not in the next 10 days, maybe not in the next 10 weeks, but over time. And there are a lot of knotty issues, and there's no doubt. Knotty, K-N-O-T-T-Y, not naughty, but maybe both senses, to work out with the Chinese on intellectual property theft and espionage and who knows what else. So there are genuine concerns, but I don't think it's in the Chinese interest and it's not in ours. The president said it's easy to win trade wars. It's not, and no one wins trade wars. Everyone loses. So hopefully we won't have a trade war. We have a skirmish, parsing words. A trade war would be if we raise the tariffs from 10 to 25, and the other almost 300 billion we import from China, of which there are no tariffs, go to 10%. And the Chinese retaliate by raising tariffs on everything that we sell to them, beyond what they are now, and they sell treasury bonds. That's a trade war. And that's a war that neither side will win, and there will be a lot of economic casualties. I don't think that's going to happen. Now for the pictures. Here's the stock market. These were monthly averages. Now this chart is pretty out of date. I haven't had a chance to update it since yesterday. So who knows what happened, today. Well, it's not quite as crazy as it was. You can see last October, November, December, where we hit bottom in December, a little bit up in January. That last light shaded bar was the close as of Tuesday night. Or maybe it was last Friday night because I updated it on Tuesday. Nice rebound. I think that's important. Why has it happened? Because as I say, I think the talk of recession that was so prevalent, particularly when trading was thin, in December has abated, and rightly so. The Fed, which I think did add to the uncertainty, and Chairman Powell, I think back on December 19th, when he had a press conference and announced that the Fed had raised the rate 0.25%, didn't help the market. I think there was miscommunication that he has since cleared up, and now the Fed, as they say, has come to full stop, rather than saying we intend to raise rates and maybe not even shrink our balance sheet as quickly. So, some improvement. What they say about the stock market is true. It has predicted, I think, 10 of the last 5 recessions. So keep that in mind, that the stock market is anything but an infallible predictor, but also should not be ignored. And that is what the Fed is saying. And we've seen this nice rebound, and we think actually the market's probably come up a little fast. Somebody asked me for a short run. I think one of the students asked me for a short run forecast for the stock market. That's anybody's guess. Because who could have predicted 3 months ago the market would tank like it did and then come rebounding? Volatility is back and is more normal. I mean, that was a little accentuated. But 2017, the market had no volatility. That was the exception, not the rule. 2018, we had more volatility, and that's more typical. Maybe, as I say, in somewhat of an extreme version the last 6-8 weeks of the year. And now we've had this nice rebound. So I can give you a definitive forecast, since you asked, for what the stock market is going to do in the short run. It is going to go up, and it is going to go down. And that's about as definitive as I can possibly be. It'll do that day to day and hour to hour. But if you ask me, what do we think about the market based on earnings, based on the Fed freezing rates for now, based on an economy continuing to grow, but a little less slowly, we think the market goes up from here. Now, that doesn't mean it doesn't go down first. And in fact, we were telling our clients, that's one of the things I still do with PNC, and one of the things I enjoy. I work with our asset management group on the investment policy committee. We were telling our clients back in October, November, December, if you have any cash, put it to work. Well, nobody wanted to hear that. But the one thing we try to do is say, don't panic. Don't get sold out of this market at the tail end of the year when it's down almost 20% at one point, or even down 10 to 15%, do no harm. Don't sell. If you don't want to buy, just grit your teeth and work through this. And so far, I think that patience and strategy has been somewhat rewarded. Here's consumer confidence and business confidence. Like I said, big drops the last couple of months. The orange line is small businesses. The blue line is the American consumer. I think that's the Conference Board Index. Yes, they took a big hit the last couple of months. How much of that was the stock market? How much of that was the government shutdown? How much of that was the polar vortex in this part of the country the last couple of weeks? But I'm going to make you a prediction. When I update this chart for February, I think those numbers are going to rebound, just like the stock market did. Not back maybe to where they were at their highs, but I think over the next couple of months, they're going to get back half of that, if not more. So that this drop was probably, as they say, temporary and overdone, and some of that will be reversed, which will be a positive sign, again, for consumer and business spending. Here's our economic growth. I mentioned GDP. Blue line, 18. Not quite finished yet, 3% in round numbers. Notice that's one of the best growth rates we've had, frankly, in this whole expansion. No year did we grow 3%. That's what I meant by saying this has been a long but a relatively slow economic expansion. Now, Trump and the administration came out and said 3% is the new number. We're going to cut taxes, and that's going to unleash the sustained period of 3% economic growth. I didn't believe it then. I certainly don't believe it now. It was hyped up, and that without labor force growth and some better productivity, you're not going to sustain 3% economic growth. So this year, we're forecasting just about 2.25%. So more in line, frankly, with the average of, oh my God, the Obama years, when growth was halting and slow, and everyone who watches Fox News knows we were in a prolonged economic recession. Growth is going to be back down at the Obama recession growth rates probably this year and next, and that the 3% was more the exception. And in the wake of that huge increase in government spending and tax cut is $1 trillion deficit for the next couple of years, which we can talk about a little bit later. So a little over 2%, a little under 2%. Not recession. You know what recessions look like? That. Or maybe if I'm a little taller, or even the one in 2009. That was one of the worst recessions we've had in 60 years. But if I'd taken this back 20 or 30 years, I could have showed you some bad numbers in 2001, in 92, 93, 74, 75. All of those, of course, pointed down. That's a recession. This is not. Unemployment rate. The blue line is the official rate, just at 4%. Went up a little last month in January, but I think the government shutdown and the way the numbers are collected probably pushed it up a little, and I'd be expecting when we get the data for February and March, it's going to go back down again. Look at how many times, even since I've been alive, that we've been under 4%. Not too many. The 60s. We briefly touched there at the end of the 1990s. Remember, that was the longest economic expansion, and we got the 4%. Here we are at 4%. And our forecast is we're headed to 3.5% over the course of this year and into next year. So all you young people are going to get jobs, and you're going to get good jobs in what is a pretty tight job market, and we haven't seen bottom yet. Here's jobs. These are the growth in jobs by month. You get that data monthly. So I took 3 months and averaged them, because up, month to month, they're even much more volatile. The last 2 months, that's the 3 months ending in December and January, we've had the best job growth we've seen since you can see in about 3 years. We had super strong numbers. Now that's probably not sustainable either. And it's probably going to head back down toward maybe 150, at most 200. But again, I don't show it there, but if you want to know what recessions look like, I could show you what jobs were doing in 08 and 09. And it looks just like that chart, turned upside down, where they're down 200,000-300,000 a month and several million a year for not a month or two, but that was almost 18 months. That's not happening. But it's not going to stay up as high as it was. Wage growth. As I mentioned, it took a long time, but wages are finally hitting 3%. The blue line, by the way, that's the quit rate. That's the take this job and shove it. People who are just quitting the market or quitting their job and saying, I can do better on my own. That doesn't happen except in strong job markets. You can see where it was in 2010. Nobody left voluntarily. Now it's up because the scale over there, I guess, is this side. So about 2.4% of people are quitting their job and either going, that doesn't mean they're going unemployed or retiring. That means they're looking for another opportunity, starting their own business. They feel confident. And wage growth approaching 3%. And our forecast is it will be above 3%. So if you're thinking of wages for your employee for the next couple of years, and your wage gains don't start with a 3 handle, you're probably going to lose those people to competition. Or, they're going to feel, quote, or underappreciated because the national average trend has gotten up to the mid to low 3s. Housing. This is one area we haven't talked a lot about. Housing has not contributed a lot to this expansion. But then again, you could see what happened a decade ago. We've never been starting 2 million homes. And employment. And we know the little proverbial house of cards. And we spent 7 years, housing market collapsing, taking the whole global economy with it. And we're growing. Now, jobs are still growing a bit faster than housing starts. It's looking better for housing starts. As mortgage rates have come down, with the Fed going into kind of pause or freeze. I think the next couple of months, once the weather improves in this part of the country, we're going to see some much better number on housing starts, which again is a positive for consumer spending. Because when you get into a new home or you buy an existing home, anyone ever do that and not spend money? I don't know who you are, but if you can move into a place and not spend anything to make it your home, you're pretty unusual. So that's where some of that spending is going to be. Car sales, car and truck, vehicle, been around 17 million. That's been good for the Midwest. Sales and production of cars have done very well. Of course, there's a lot of churning between cars and trucks, as we've seen from GM. We've also seen, of course, the steel and aluminum tariffs have done a lot to help steel companies in the short run. They've hurt a lot of course, the companies that buy from them, and that adds a little bit of inflation. Last month, that last number you see is January. Sales dropped a little. How many of you were out looking for a car around here in late January? Did you put on a snowshoes and a snowsuit and go out and look for a nice convertible? Probably not. And that is part of why those sales dipped, and I suspect they will come back up as well. Gasoline, energy prices. Big drop since October, probably hitting bottom. As I mentioned, gasoline prices fell over 20%. In terms of money, that's 50 or almost 60 cents a gallon. Now, the levels are different, and they're higher here in the Midwest than they are maybe in the South. But the change put a lot of money in people's pockets. And now they probably hit bottom. But that drop, one, not only helped inflation hold it to zero, but it put a lot of money in people's pockets. Now, some of you may be asking, that are junkies and follow this. Last week, the government put out a report on retail sales for the month of December. The key month, holiday sales. And they showed the biggest drop in retail sales we've seen since 2009. So obviously, I am full of crap. I have no idea what I'm talking about. The government said no one is spending any money. Is that number to be believed? I think it's a fat finger number. Amazon reported what? 18% year over year online sales. In the government's figures, it was 4%. Walmart just came out and said they had their best holiday ever. Well, I know they're a small little retailer and they probably don't represent what's going on. But when Walmart says it's the best holiday they've ever seen, when Target had good numbers, when Amazon had good numbers, the number just doesn't make any sense. And it confounds or conflicts with other data, private data from Visa and MasterCard. So if I thought December weakness was a harbinger of something serious, I'd have to change my forecast. I'm betting that as we get more data, either December gets revised up or they don't want to admit they screwed up December, but when they get data for January and February, you're going to see this big, oh my God, I can't believe how strong retail spending was in January and February. The reality is it wasn't that strong in January and February, but it wasn't that weak in December. And if you average the 2 or 3 months, we had a good holiday season and probably a decent start to consumer spending in the first couple of months of this year, given delayed tax refunds, given the government shutdown, and everything I said earlier about the consumer, I still believe is true. Here's inflation. I mentioned earlier the Fed not being in any hurry anymore to raise rates. Here's one of the key reasons why, and Chairman Powell said that. These blue and orange lines are measures of inflation that the Fed prefers. It's not the consumer price index. It's like the fraternal twin of the consumer price index. Now, this one must have been born second because it's always a little smaller. I don't know how the biology of that works, but this thing always comes in a little lower than the CPI. The green line is the Fed's objective, 2%. By the way, did I tell you about the types of economists there are? There are 3 types of economists. There are those who can count, and there are those who can't. Those are the 3 types of economists. So I want you to keep that in mind as I go through all these numbers. But in reality, 2%, they didn't get there last year. The data are just now in. We're forecasting they still won't get to 2% this year, maybe next year. Why would the Fed be in a hurry to raise interest rates, which tends to dampen inflation, when it's below their objective. And that's why they're not going anywhere, maybe late this year, because we think inflation is going to head up a little, and the Fed might want to still have one rate hike left, but pretty much done. That is probably the one chart that tells you why the Fed sort of did the screeching halt. The global economic problems, and they listed it. The government shutdown, and at the time the Fed met in late January, they didn't know the government shutdown was going to end a couple of days later, and who knew if it was going to start up again. They don't know how Brexit's going to come out. They don't know what our trade negotiations with China are going to do. They listed them. Why they thought it was prudent to wait and see, and rightly so. And in their forecasts, which don't look that different than mine, they're not chasing inflation. This isn't a cat out of control chasing its tail. So the Fed isn't trying to corral inflation by raising rates. And here's our forecast on rates. As you see, we got up above 3% on the 10-year Treasury. Right now it's around 265. It's come down almost 0.75% as the stock market collapsed or corrected. The upper green was mortgage rates. They got up to almost 5%. Now they're back down to around 4.5%. We don't see much happening there. Staying about where they are, 2.75% to 3% on the 10-year, maybe 4.5% to 4.75% on the mortgage rate. And that's partly why we think housing will do better. And as you see, that bottom line is the rate that the Fed controls. Flat, one little bump late this year, and then flat again. So not a lot of movement out of the Fed, and I think that's positive for the U.S. and the global economy. Now, it's made the dollar a little weaker. The dollar's been extremely strong. It's sort of leveled off. Our view is that the dollar probably will get a little weaker, but when you're looking at what's going on in the rest of the world, the uncertainty over Brexit, how the ECB, the European Central Bank, is going to act. We're talking about maybe raising rates this summer. With Europe flirting with recession, there's no way, and inflation that's below their target, which is also around 2%. European Central Bank's not going to raise rates. Japan's holding rates at 0. That 10-year rate is at 0. Australia just lowered rates. India just lowered rates. China has been raising or lowering reserve requirements, doing everything they can to stimulate their economy. There's not going to be much, if any, upward pressure on interest rates in the global environment, let alone here. So let me finish it up. Positives and negatives. Jobs and income growth strong. Like could remain. Regulatory reforms, I haven't talked too much about it, but there have been positive regulatory reforms. Maybe some of you have felt in your business over the last couple of years. Lower crude oil prices, although I think they've hit bottom. But if gasoline gets to $3 a gallon, national average, by Memorial Day, because that's usually when it peaks, between Memorial Day and July 4th, might be a little higher here. If it gets there, that would be probably the 5th year in a row that gasoline got to just shy of $3 a gallon around the height of the driving season, Memorial Day to July 4th. Is that really going to hurt consumer spending? It'd be better if it stayed at $2.50 where it is now. That's not going to happen. But to go to $3 a gallon, up 50 cents, it's normal. If it went to $4 a gallon, because oil went back up to $100 a barrel, that would be a problem. Oil's probably not going up much more than $60, $65 a barrel, which is where it was last spring. And in fact, the year before, it was even lower than that. That's when gasoline, I guess it was 2016, was almost $2 a gallon. National average, maybe $2.25. So a little higher than that. But oil is a positive for the U.S. economy, and we're a huge oil exporter or producer. And so $30 a barrel oil actually is terrible for the oil-producing U.S. economy. And $90 is terrible for the oil-consuming U.S. economy. So where's a good number that's sort of the right sweet spot? Probably somewhere between $50 and $70 a barrel. and we're right now around 55. And I think that's a good place to stay. Economic growth around the world is going to be slower, but it's probably not going to be a recession. The IMF, the International Monetary Fund, put out 3.5% growth for the global economy. You leave the U.S. out of it, it's a little lower. Recessions in the global economy is when that number's under 3. So we're close, but not recessionary. And then the things I worry about. Are we going to come to a deal with the Chinese? Or if not, are we going to accelerate these tariffs and retaliate? That happens, all bets are off. The economy is going to be much worse off, and nobody's going to win that trade war. I just don't think that's likely to happen. We'll know in probably another 90 days or less whether I'm right or not. Robert Mueller, is he really done? I mean, law and order gets done in an hour. They commit the crime, they find the guy, they take him, to court, and he spends the rest of his life in jail. That happens in an hour. It's taken him 2.5 years. Americans are, I think, a little tired of this long law and order scene. I think we'd all like to see what he's been working on. I won't predict who's going to get indicted or not indicted. I think there's probably some smoke and some fire there, but maybe we're finally going to see it, and who knows? Maybe that'll upset the markets. Donald Trump Jr. indicted. I have no idea, I'm just guessing, but something like that where the president goes tweet crazy and the markets say that's bad, he's in a bad mood, and either his hair's on fire or it's just orange as usual, we can't quite tell, or I guess it's his face. But in any event, that could be bad for the market. Fiscal tax cuts, we said there are not going to be any more tax cuts. The House is controlled by the Democrats. They're not going to agree to cut taxes. If anything, all the candidates talk about raising taxes. So you're not going to have any more fiscal stimulus. An infrastructure bill, that would have been great if the president, frankly, had done that a couple years ago. I think he missed that big opportunity. Where are we going to fund $1 trillion of well-needed infrastructure when you're already running $1 trillion deficit? So it's not going to happen. And I think it was a missed opportunity, but that's not going to stimulate the economy. Immigration restrictions clearly holding back, I think, economic growth because of the unavailability of labor supply. As I said, who knows if we'll have a hard Brexit. I think the risks are that we won't, or the odds are we won't, and who knows about terrorism. So a lot of up arrows and down arrows. But bottom line, I think what they add up to, in the most likely case, is continued economic growth, no recession. To be sure, slower, but still consistent with good job growth, good earnings growth, probably 4 or 5%. I've heard a number of people on CNBC. You know what CNBC is, constantly negative business channel. That's CNBC. I've started watching Bloomberg because every day I turn on CNBC, they find the most bearish earnings guy or the most bearish economist to bring out. They're what I call the vampire economists. They're the people who live in their coffins most of the time because the economic data is pretty good. So it's sort of economically sunny. And we know what sunshine does to vampires. But as soon as you get a bad retail sales report or you get a government shutdown, they're all over CNBC saying, man, this is bad stuff. And the economy is going to hell. And the stock market is bad, and ignore them. Don't not watch CNBC because, well, I used to get on there. Probably not after that. But in any event, I would like to get on there so I could debate some of them in the past. But I think you're going to find the U.S. economy still has some life left in it. And we're going to beat 10 years and going strong, or at least going, if not strong, at least moderately, through the rest of this year. Next year, it's a presidential election year. Anything can happen. Recessions usually don't start in presidential election years because the party in power usually tries to do everything they can not to have that happen. So I'd even suggest next year you're not likely to end up in a recession, but as I said, slower growth. Earnings growth, mid-single digit. The stock market, much more reasonably priced now than it was 4 months ago. with Fed now stable because interest rates are obviously in the denominator of our present value calculation on the stock market, they're going to stay where they're at. If anything, they've come down a little bit. So that tells us there'll be volatility, but probably still some upside potential. And if the market were to go down 5 or another 10% because of some bad tweets or concerns about China, and if we know the president prides himself on the market going up, that actually is a message he heeds and can change his reaction. If he sees the market go down, it may be sending him a signal, the one thing he may listen to say this isn't such a good idea, especially with re-election getting closer day by day. So our view is remain at least cautiously positive or optimistic about the U.S. economy. Now, some would say that an optimistic economist is an oxymoron. And in fact, I've been told I'm just a plain moron. So we will see. Time will tell. But I promise Dan, your program director, that if he can't find a good economist to come back next year, I will be glad to come back, own up to what I told you today, correct all my errors. Of course, last year I was exactly right, so there was no point in having to revisit that. But a year from now, I'll come back and face the music, and I think what we'll find is when I update my charts, that we'll now be in about the 115th or 16th month of recovery. And while we might be closer to a recession a year from now than we are today, because they're not outlawed, they're eventually inevitable, I think at least as we look back a year from now, if you were patient in the market, if you ran your businesses to capitalize on moderate economic growth, but not batten down the hatches to prepare for a recession that doesn't come, I think we will all be better off. And on that note, I thank you very much, Dan and Frank, and all of you for inviting me back. You have one of the best. I speak to a lot of FEI chapters. Really, you guys are one of the best, maybe the best, in terms of the activities. Congratulations to all the students. And on that note, that's my forecast, and I'm sticking to it. Thank you very much. That it's around, which was a gift from my wife, that it's around 7:45. I know we all have places to go, but if there are a few questions, I would be glad to have a few questions and then stick around for a few minutes after that. But great, thank you. Let's start right here. And I'll repeat the question in case you can't hear it.
Stu, you didn't talk about the yield curve. Can you tell me about the yield curve and then where you think it's going to go and how it's going to affect?
Yeah, great question. Yield curve, and I even had something up there, but you're right, I glossed over that. What is the yield curve? It's the spread between short-term, typically treasury rates, and longer rates. And one of the things you really get concerned about is when that curve inverts. By that it means the longer rates are lower. Longer meaning longer in maturity, 10, 30 years. You get paid less interest than for 3 months or a year. I think the best measure of the yield curve is not the 2-year treasury to the 10, although that gets a lot of attention. I think it's really probably the 3-month to the 10-year. Now, right now, the 3-month rate is around 230, right below the Fed funds rate, which is around 240. The 2 years around 250. The 10 years around 265. So that's pretty flat. If I drew a picture, there's not a lot of slope there, but it's not inverted. And nor do we think the curve is going to invert. If the Fed raises rates one more time later this year, and this may be one of the reasons they don't, you could see that curve flatten out. And there is some partial inversion. I think the 2-year rate is 250. The 5-year rate is like 247. So it is lower than that. But I think we're splitting hairs when we talk about 2 or 3 basis points. In the past, inverted yield curves were not a matter of handful of basis points. They were 20, 30, 40 basis points where the long rates were below the short rates. And as I said, not 2 versus 5 year, but 3 months versus 10. I would be much more worried about the economy if that curve had inverted. It has not. It has flattened. Yield spreads between treasuries and corporate bonds and high yield bonds blew out in the debacle, have narrowed part of the way. Financial conditions have somewhat improved as Goldman Sachs keeps a chart and a tally of it. So yes, the yield curve is flattish or slightly positive sloped in the relative 3 to 10, and then of course the 30 years above the 10 year. 30 years around 3% or just under, and the 10 years 265. I don't think the yield curve will invert in the next year or so, and therefore will not send out the classic recessionary signal that it has so many other times in the past. Good question. Yes, sir.
Debt in the economy,
Yes.
whether it be corporate debt, because interest rates were so low and a lot of debt was raised, or student loans or auto loans. You know, the debt bubble got us in the mortgage time frame, China's shadow banking system. Speak a little bit about debt and its impact. And then when we finally do hit a recession, how do you deal with that, given the toolbox is a little lighter than it was previously?
Yeah, if you couldn't hear that, the question was about debt. And as I say, the student debt, federal government debt, I think corporate and consumer debt is actually actually not so bad. But there's no question that the federal government debt is a problem. And it's a great question. But I see we're out of time for questions, so thank you very much. I meant easy softball questions. I didn't mean tough ones like that. That is a big question. I don't know the answer. For the next couple of years, we're going to deal with the debt. The world still wants U.S. treasuries. They still think the dollar can hold its value. That's the reason the 10-year treasury is 265 and not 365. So there is an insatiable demand, partly because what do you get if you buy Japanese 10-year debt? Zero. Okay, well, forget that. I'm going to go to Germany, a good, stable country. I'm going to buy their 10-year debt. What am I going to get? 12 basis points, 1/8 of 1%. You're going to get 265. The spread between our 10-year treasury and the German 10-year treasury, the Bund, I don't think has ever been wider. Okay, so you go to Britain. That's about $1.35, and that's a great country to invest in right before breakfast. Oh, go up to Canada. They're pretty good. We haven't started on the Canadian wall yet, so you can still get over there, and you can get about maybe $1.20, or 1.2%. We still have that. Go to Australia. Okay, finally, I think if you go to Australia, you can get 3% on a 10-year treasury, although Australia has higher inflation than us. Australia, by the way, hasn't had a recession in 26 years. So recessions or expansions can last a long time if you have good economic policies and lots of kangaroos and koala bears. But that's not there. So clearly we should be importing more cute, fuzzy animals. But in any event, the Treasury is still one of the highest rates in the world with a stable currency, even if it's a little weaker. So I don't know when that's going to change. As you said, in the next recession, we do have less ammunition, although the Fed will cut rates, maybe go back to buying treasuries again. So there is a debt problem out there. And, maybe in 3 or 4 years into the 2020s, there could be a lot of payback. And depending on who's elected in 2020, not only the White House and the Congress, all kinds of things will happen. But the most important thing to me about the economy in the early 2020s is I'll be retired and I won't have to predict it anymore, so the hell with it. Let Gus Fauché figure out what's going on. But now that is a good question. I've given you a half-ass partial answer, but because for the next couple of years, this debt is not a problem. As long as the world wants to own our bonds, and right now they do in droves. Sure.
Comment on manufacturing productivity past and what's your forecast and what economic indicators do we need to worry about?
Yeah, manufacturing productivity. It's the one we can measure the best. I mean, we have productivity numbers for the whole economy. They've been disappointing. Last couple of years have been 1.25%. Manufacturing has been higher, and it's probably a number that's much more tangible. It's a little easier to measure manufacturing productivity, but even there, it's been disappointing. That's one of the reasons why I don't think economic growth could stay at 3%. Economic growth is usually made up of people working, or at least hours, the productivity, and the investment tools they work with, and of course the number of people in the workforce. Well, our internal population growth is 5%, or 5.5%. If we're not going to allow a lot of imports, legal, let alone illegal, how are you going to get 3% growth unless you get like 2 to 2.5% productivity growth? That would be great, but we haven't seen that in decades. So manufacturing, I don't have specific forecasts, but manufacturing productivity growth is probably going to remain around 2%. But I would say the rest that isn't as well measured is probably closer to 1. And then when you weight average, given the productivity growth or manufacturing in terms of output, not in terms of employment, is about 25% of the economy, you can do the math. Total productivity growth is about 1.25%. So I think you still get productivity growth in manufacturing. There's a lot of incentive to do that. There's a lot of technology to do that. As wages go up, it's even more incentive. And I don't mean with robots, I mean with people in the short run. But I don't think we can get enough productivity growth to sustain 3% economic growth indefinitely. But manufacturing productivity growth will be much better than many other industries, although those industries are much harder to measure, and that's why maybe we're understating them, but the official statistics look, pretty disappointing, less than 1%. There was maybe a couple other questions. Yes, young lady? Yeah, the question about China more generally. They've been growing, quote, 6 to 10%, more recently 6 to 7%. But it was partly the law of small numbers. I mean, when they were $5 trillion, maybe a third of our size, they could grow at 6 or 7%. You know what? There was a time, even before I was born, when the U.S. economy could grow 4 or 5%. I think it was called the 1800s. But we could grow because we were where China was 150 years ago. Industrial Revolution, all of that stuff. China can't keep growing at 6.5%. They're too large, and they can't get that productivity. They certainly have no shortage of labor supply near term. They will over time because of the one-child policy that they've recently let up on, but the demographics for China look almost as bad as Japan. They don't have a lot of young people because they've had very low birth rates. In the Chinese case, by regulation. In the Japanese case, I guess, and partly in the U.S., but nowhere near extent, just by culture. But I think the Chinese economy is going to slow. I think the real number, as I say today, is probably less than 5%. And if 3 or 4 years from now, the Chinese admit they're growing 5%, and somebody says, oh my God, they're only growing 5%. What is 5% of $15 trillion? Which is, or 14, which is what they're going to be. That's still a pretty damn impressive number if we're growing 2% on $22 trillion. So they're going to slow down, in part because natural economic forces. They're doing everything they can to stimulate their economy right now. But I think the next couple of years, with or without tariffs, certainly with, but even without, the Chinese economy is going to continue to decelerate, even if they don't admit it. But to say, oh my God, that's a hard landing, or China is no longer the engine of world economic growth, when you're 5 trillion, you can grow 8 or 9%. When you're 15 trillion, you can't do that, at least not legitimately, without having other problems. And the Chinese, if you worry about having debt, the Chinese make us look frugal. But of course, it's debt that they kind of owe to themselves, a bit like the Japanese did 30 years ago. But the probability of a debt problem in China, I think, is much greater than in the U.S. It's just the difference is they can just pretend that that doesn't exist and there's no international demand for Chinese bonds. It's all internal, so they can probably get away with it for a very long time until they really want to free up their currency and become more a member of the global financial markets. Then that debt becomes a real problem. Yes, maybe one last question. The question was, is there a time we're going to start talking about unfunded pension liabilities as true debt? Well, not tonight, but I'm sure there'll be a time. That's an offshoot or very much related to that question. That was the debt. You have these unfunded liabilities. You guys know about that pretty well in this state, so I won't say too much more about that. By the way, the Chicago economy that I didn't talk much about is sort of growing at a moderate pace, and I would not expect it to do much different than the national trend, maybe even a bit slower. But you've made some good gains in your job market. The unemployment rate is 4%, almost the national average. But in terms of, are we going to ever start talking about it in a political sense? And I don't think so in the next election. But I'm sure that the ticket of Sanders and Warren will take care of it when they are elected in 2020. They will make sure nobody's debts are too small to be forgiven. On that note, I thank you very much.